Hello students. In the types of leverages, there are three types of leverages. They are operating leverage, financial leverage and combined leverage. I have done the first leverage, that is operating leverage, and have done the problems under operating leverage. Today I am going to discuss with you the second type of leverage, that is financial leverage. Now let us see the meaning of financial leverage and then we will go to the problems under financial leverage. A fixed cost is the operation creates to magnified effect of change in sales on the operating profit or EBIT. In the same way, there is also a fixed factor on the capital structure of the company. All the debt, securities and preference shares are to be paid the interest dividend at a fixed rate. Operating leverage, the meaning is when there is a fixed cost in the cost sheet, if they increase the sales by just 1%, there will be a magnified or a double effect in the profit. That is the meaning of operating leverage. Now financial leverage meaning is if there is a fixed cost. Now what is a fixed cost? Fixed cost is nothing but the interest you pay for the debt holders, debentures, bonds and loans. If there is a interest in their income statement, if they increase the sales by just a small portion, there will be a magnified effect on their profit. Okay, so the difference you see in the operating leverage, there is a increase in the fixed cost if there is a presence of fixed cost. In the operating leverage, if there is a presence of fixed cost and if they increase the sales, what is the effect on operating profit? That is magnified effect. Now in the financial leverage, there should be a presence of fixed cost, fixed charges. Okay, fixed charges, that fixed charges is nothing but the interest you pay for the debt holders. If there is a interest to pay to the debt holder, if there is a change in the sales by small portion, it has a magnified effect on the profit. Now let us see the formula to calculate financial leverage. There are two formulas to calculate financial leverage. The first one is when preference shares are not there in the share capital. If in the problem preference shares are not given, in that case to calculate the financial leverage, the formula is EBIT divided by EBT. When the preference shares are not there, okay, so you have to note down here, when the preference shares are not there, you have to use EBIT divided by EBT. When preference shares are part of the capital structure, when preference shares is there in the capital structure, then the formula is EBIT divided by EBT minus P divided by 1 minus T. Okay, the formula is EBIT divided by EBT minus P divided by 1 minus T. This is a formula you will use when the preference shares are part of the capital structure, if there is a preference shares in the capital structure. Okay, now let us go through the problems under financial leverage. I'll read the problem first, then we will solve the problem. From the for the year ended 31/3/2007, A Limited has earnings before interest and tax, that is EBIT, 70,000 and equity share capital of 1,40,000, and an annual interest burden was rupees 10,000. So they had a EBIT of 70,000, they had a equity capital of 1,40,000 and an annual interest burden of rupees 10,000. It assumed issued 510% preference shares of rupees 100 each at par, and its EBIT for the year ending 31/3/2008 went up to rupees 1,20,000. So what happens is they have issued, okay, this is the second part, they have issued a 500% preference share, 500 shares of rupees 100 each at par. Then the EBIT goes up to rupees 1,10,000. When there was no preference shares, the EBIT was 70,000. When there is a preference shares in the year 2008, the EBIT went up to 1,10,000. calculate the financial leverage of the two situations, that is before and after the issue of preference shares. Also discuss the effect of issue of preference shares on the financial leverage of the firm. Assume a tax rate of 30%. So the tax rate is here 30%. Now we have to calculate before issuing preference shares and after issuing preference shares what is the financial leverage. So in order to calculate financial leverage, the formula is EBIT divided by EBT for when there is no preference shares. When there is a preference shares, EBIT divided by EBT. It means we have to prepare the statement of income till EBT. We want EBIT and EBT for the formula. So we will prepare statement of income, that is of 2 years, 31/3/2007 and 31/3/2008. EBIT for 31/3/2007 is 70,000 and for 31/3/2008 is 1,10,000. Less interest. You know, from the EBIT we have to deduct the interest. Interest is given in the problem. Annual interest burden is 10,000. So write 10,000 and 10,000. No, for both the year the interest was there. The difference was only the preference shares. Okay, so 10,000, 10,000 deducted. 70 minus 10, 60,000. Here 1,10,000 minus 10,000, 1 lakh. Less tax. Here, as per the format from the EBT, we have to deduct the tax. Tax will be calculated on EBT. So 60,000 into 30%, 80,000. 1 lakh into 30%, 30,000. So from the 60,000 deduct 18,000, you will get 42,000. 1 lakh minus 30,000, you will get 60,000. 1 lakh minus 30% of the shares, you will get 1 lakh minus 30,000, it is 70,000. 70,000 you will get. Less preference dividend. If there is any preference dividend, you have to deduct here. So the preference dividend here, it is given in the problem, that is before there was no 2007 there was no preference shares, so put dash. 2008 there is a preference shares of 10%. So 500 into 100 into 10%, 500 into 100 into 10%, calculate and write in 2008 it is 5,000. Okay, so here surplus profit is 42,000 and here the surplus profit is 65,000. Okay, so 42,000 and 65,000. We have prepared here full income statement, because when preference shares is given we have to calculate the preference dividend. That's why I have done here a full income statement till the end. The format I have given you in the beginning itself, the same format you have to follow. Sales minus variable cost contribution, contribution minus fixed cost EBIT, EBIT minus interest EBT, EBT minus tax EAT, EAT minus preference dividend, surplus profit. So this is how I have done here. Now we have to calculate the financial leverage using a formula. Now 2007 there is no preference shares, 2008 there is a preference shares. So the formula you have to calculate, see, financial leverage for 2007, that is before preference share, the formula is EBIT divided by EBT. So EBIT is 70,000, EBT is 60,000. So 70 divided by 60, 1.167. You will get 1.167. Second, financial leverage for 31/3/2008, 31/3/2008, EBIT divided by EPT. The formula will change here. I have told you in the first slide, if there is a preference shares, the formula is EBIT divided by EBT minus P1 minus T. So same is applicable here. EBIT divided by EBT minus P1 minus T. That is EBIT is 1,10,000. EBT is 1 lakh minus preference. P refers to preference dividend. So you see here preference dividend is 5,000 here. So you will go here and write the amount 5,000. 1 minus T, that is 1 minus 0.3. 0.3 means 30%. 30% divided by 100, you will get 0.3. Okay, so then you simplify it. 1 lakh 10,000 divided by 1 lakh minus 5,000. 1 minus 0.3 is 0.7. So 1 lakh 10,000 divided by 1 lakh minus, you divide this, you will get 7,142.85. Then divide this, you will get 1.184. Okay, so the formula is different here. The first formula is used when there is no preference shares. Second formula is used when there is a preference shares. P refers to dividend, T refers to tax, rate of tax. So rate, if it is 30%, 0.3, 40%, 0.4, like that. Simplify it, you will get the answer. I have written a comment here. The leverage has gone up from 1.167 to 1.84. The leverage has increased. If you see the value, the leverage has been increased from 1.167 to 1.184. It means that because of the presence of the fixed cost, that is preference shares, because of the presence in the preference shares in the second year, that is 2008, the leverage has gone up. See, as a preference shares carry fixed rate of dividend, has brought the benefit of leverage. So it has brought the benefit of leverage because of fixed cost, that is preference shares, and one is interest, that is fixed interest. Okay, so here just comment you have to write, it has gone up because of the presence of the preference shares. Okay, so this is a problem under financial leverage. So financial leverage, remember there are two formula, one is without preference shares, one is with preference shares. Okay, so you prepare the income statement, calculate EBIT, EBT. If there is a preference shares, use another formula. If there is no preferences, this, the EBIT divided by EBT. Let us see the third type of leverage, that is combined leverage. Combined leverage is a combination of operating leverage and financial leverage. It means if both the leverages are combined together, we get a combined leverage. Okay, if both the leverages are combined in the sense, if there is a presence of fixed cost and if there is a presence of fixed charges, both are present in the capital structure and in the income statement, if they increase their sales, it has a magnified effect on operating profit. So combined leverage quantifies the total magnified impact on EPS for a given increase in sales. So your EPS will increase because if you increase the sales. Why? It has a presence of total risk which is exposed to both the operation and the financial structure. It is a presence of both operating and financial risk, both are present. Then if they increase the sales, it has a magnified effect on EPS. There are three formulas here to calculate of combined leverage. One of the simplest formula is when you have calculated operating leverage and financial leverage both, then you have to multiply the answer. So the formula is combined leverage is equal to operating leverage into financial leverage. Okay, this formula you will use when you have calculated operating leverage and financial leverage. Next, when you have to calculate using the formulas, then when the preference shares are not there in the capital structure, then the formula is contribution divided by EBT. When the preference shares are part of the capital structure, the formula is contribution divided by EBT minus P1 minus T. Like in the financial leverage, I have explained you there are two formulas, without preference shares and with preference shares. Here also there are two formulas, when it is not a part of capital structure, when it is a part of capital structure. Okay, so two formulas you have to use here, combined leverage. Total three formulas. One is the simplest formula, operating leverage into financial leverage. The second formula is when there is a presence of fixed cost. Third is when there is not present. Second, when there is a presence of preference shares. Now let us see the problem under this. A small scale industrial unit was selling its output at rupees 10 per unit with a variable cost of rupees 4 per unit and a fixed cost of rupees 10,000. It paid rupees 5,000 as a bank loan, interest as an interest, and paid a tax of 40%. Calculate operating leverage, financial leverage, combined leverage, assuming an output of 5,000 units. Here you have to calculate all the three leverages. You know the formula to calculate all the three leverages. You need operating leverage. The formula is contribution divided by EBIT. Financial leverage is EBIT divided by EBT. Combined leverage is operating leverage into financial leverage. So before that we have to prepare the statement of income. Write the heading statement of income. Sales units 5,000. 5,000 into rupees 10 per unit. So 5,000 into 10, total 50,000. Less variable cost. Variable cost is given here. Variable cost is 4 rupees per unit. So 5,000 into 4, 20,000. 50 minus 20, 30,000 is a contribution. Less fixed cost. Fixed cost rupees 10,000. Fixed cost rupees 10,000. 30 minus 10,000. Total EBIT 20,000. Less interest. Interest is rupees 4,000. So interest 4,000. 20,000 minus 4,000, 60,000. Less tax 40%. Tax 40% on 16,000. 16,000 into 40%, 6,400. So the EAT is 9,600. Formula: operating leverage is equal to contribution divided by EBIT. Contribution 30,000, EBIT 20,000. 30,000 divided by 20,000, 1.5. Next, financial leverage formula is EBIT divided by EBT. So EBIT, here you have calculated EBIT is rupees 20,000. EBT 16,000. 20,000 divided by 16,000, 1.25. Combined leverage. Combined leverage is equal to operating leverage into financial leverage, because we have calculated here both operating leverage and financial leverage. So 1.5 into 1.25 is equal to 1.875. Any doubts you can clarify. So today I have done with one problem under financial leverage, combined leverage, one problem. Thank you.